Good afternoon, everyone. Thank you very much for taking time out of your day. I'm Anthony Valeri, Director of Investment Management in Zions Wealth, and wanted to have this call to walk you through our thoughts on the market sell-off in response to the Liberation Day tariff announcements last week, with the stock market selling off Thursday and Friday, one of the worst two-day sell-offs the markets have seen since the end of World War II. In fact, fourth worst from a two-day perspective. So why don't we start at the top, probably take about 10, 15 minutes to go through my prepared remarks, and then from there go to Q&A. And so we'll start again at the top. Why did tariffs create, or that announcement create such a sell-off in the equity market? And there's really a couple factors. One, first and foremost, those tariff announcements were beyond kind of the worst case scenarios that were expected by the marketplace heading into that announcement. And not only was that announcement worse than expected, it came at a time when economic data was starting to slow. And I'll talk more about that in a moment. We're not weak on an outright basis, but certainly signs of economic slowing that only exacerbated investor concerns. So in response, economic growth is likely to slow and inflation to increase over the shorter term. So those are the impacts. It didn't help that the stock market, coming off two very strong years in 2023 and 24, was a little more expensive. That contributed to the sell-off as well. The tariffs are going to take effect. Some took effect April 5th. The remainder take effect April 9th. And the average U.S. tariff rate is estimated to increase to between 18 and 22%. That's up from about 0.5% at the end of 2024. The total amount in terms of tariffs, roughly about $600 billion in revenues expected. That's more than all of corporate taxes in the U.S. and amounts to a significant increase in taxes for U.S. consumers. So that some big news, and obviously changing sort of the trading paradigm, of which many would argue the U.S. has benefited. So stocks reacting in response to that. Why did stocks sell off so much? It's not only about slowing economic growth, but the tariffs are likely to drive corporate profits lower. And corporate profits, or earnings, are the lifeblood of the equity market. In our view, that is the key driver of equities over the longer term. And again, after two strong years in 2023 and 2024, with some expensive valuations, the market was ripe for a sell-off. In terms of the market, some segments have fared better than others. Technology and the Magnificent Seven, which led returns over 2023 and 24, have borne the brunt of selling. In fact, the S&P technology sector is the worst performing year to date, and the Bloomberg Mag 7 index, and there's a few different versions of that, down 24% year to date. So the NASDAQ composite down 19.1%. And so some of those high-flying momentum stocks have really led the way down, as is often the case during a sell-off, those most expensive components of the market faring worse. In terms of how much economic growth is expected to slow, the initial forecast is that this is going to impact GDP by 1 to 1.5%, so about a 1 to 1.5% reduction in economic growth as measured by GDP. However, I'd caution that it is still early. We are getting estimates, likely to continue to get estimates over the coming weeks, on just how much of an impact it will have on the economy. On a positive note, keep in mind that GDP over the fourth quarter of 2024 finished at a 2.4% growth rate. So if you do the simple math, that suggests the economy can withstand that hit to growth rate. And we're looking at either very slow growth or almost no growth for the full year. But again, not necessarily a recession that might be suggested with negative growth to the economy. It will bear watching, with the first quarter already slowing and the second quarter expected to slow as well. Is a recession likely? That's one of the forefront questions by market participants. And let me start by saying recession in any given year is probably a 10 to 15% probability. Those recession risks have certainly increased due to the economic impacts and the increase expected in inflation. The consensus forecast by some of the economic models that are available, Bloomberg has one, for example, that has shown a recession probability of 30% now. That's been creeping higher Some private economists have increased their expectation to 45% in lieu of the tariff news. Keep in mind that in 2022, a bunch of these recession risk indicators were as high as 65% probability of recession. Of course, that never materialized. So do take those with a grain of salt, but it is still very early to assess this and be cognizant of the underlying strength in the economy that started 2025 after a strong 2024. One of the concerns in the market is the slowdown has been mostly in what we call some indicators. There's a big disparity between the soft and hard economic data. Now, the soft data is the sentiment data that's gotten a lot of publicity in the media. That started over a month ago. Sentiment's been very negative, whether it's consumers, business sentiment, CEO sentiment, because of this tariff talk. That is often a contrarian indicator. When sentiment is its most negative, forward returns in the equity market are the best. So keep that in mind. And that sentiment's been negative. But when you look at the hard data, industrial production, business investment, consumer spending, which is down but still higher, all of those holding up relatively well. So the economy was okay as we came into this tariff announcement. So keep all of that in mind. Again, there's still lots to determine how much the economy is slow and could very well absorb this impact, and it could be sort of a flat to low growth scenario. All right, so looking at the equity markets, the S&P 500, which tried to mount a rally here today, was down around 17% peak to trough as a result of this sell-off. How far might this sell-off go? A bear market, which is defined as a decline of 20% or more, is very rare outside of a recession. Now, we very well could have a recession in response to the tariffs, but down 17% tells you that the market's priced in a lot of bad news. It's not to say it could go further, but down 17%, close to that bear market threshold, it does price in a lot of negative news. So we're in the vicinity of or close to a potential bottom if a recession did not ensue. And if a recession did, obviously could go lower from there. But I do implore investors to recognize the amount of damage. I do think this volatility will linger just to the uncertainty over the economy and also the uncertainty over corporate profits or earnings. So earnings expectations started 2025 very high at about a 14% expected growth rate. That was expected to come down. That was not a surprise. 2024 saw really strong earnings growth, up 10% annualized. That's the strongest pace since 2021. Reflects very well on corporate America. Corporate profit margins are still very wide in the low double digits. So there is room in corporate America to absorb some of the impact of higher tariff costs. But yes, those earnings are expected to come down. We've only seen a few estimates come in so far showing potentially a slowdown to about 5% earnings growth rate. And if earnings is positive, that is still a good support for the equity market. It means lower returns, but not necessarily something more severe in terms of a sell-off. So profits can absorb that decline. The lowest estimates we've seen so far about a 3 to 5% earnings growth rate. And again, a positive that'll be still positive and not negative year over year, but something to watch. Now, the reason we think volatility will linger is we won't get clarity on those profits for some time. First quarter earnings season starts this Friday, and the news on profits will probably or very likely take a back seat to guidance from corporations on what do they expect over the remainder of 2025 in terms of corporate profits. What kind of guidance are they going to give? And that's going to be the real key to observe what the impact of profits will be. We probably won't get a very clean read on profits until the third quarter. So lots of uncertainty lingering on the corporate profit picture. And again, that is a key for the equity market. And just to walk you through a scenario analysis in terms of earnings, if we do get a low end 5% growth rate in terms of earnings, that would put earnings for the S&P 500 at about $255 a share. If you apply a multiple or PE of 18 to that, that implies an S&P 500 index level of around 4,600. That's about 8% lower than where we are now. Now, that scenario analysis assumes no growth in earnings in 2026 or 2027, which is false. We would expect growth over those 2 years. So not sure we quite get to that level, but in terms of triangulating a potential bottom, that is one number that I put forth. I don't think we quite get down to that level, but again, something for investors to look for in a potential negative scenario or where we might see a bottom. The risk to that is that earnings don't grow 5%, the growth is weaker or negative, or that investors, because of the uncertainty to tariffs, demand an even lower PE ratio to compensate for the potential risks. All right, so lots of negative news in the markets. What are some of the good signs or positive news to look for? Well, several segments of the equity market are already at below average valuations. If you look at developed international, emerging markets, small caps, all are below average in terms of their historical valuations. Small caps can be more sensitive to an economic slowdown, so we'll be careful there. But international equities have held up better during this recent sell-off. Dividend-paying equities also have held up better. So some of those solid companies that maybe didn't participate in the rally in 2023 and 24 are starting to add benefits to investors. And then the PE ratio on the S&P 500 equal weight, which takes out that concentration in the market and really focuses on an even playing field for all S&P 500 companies. That valuation is down to 15.3, which is below the historical average of 16. So there are segments of the market that have weathered this storm much better. And also keep in mind the valuation change on the S&P 500, just the regular index, the market cap index. That PE ratio was as high as 25, now down to 19. When you have that much of a reduction in the PE ratio, that's significant. So it's worth noting that there has been already a sizable valuation adjustment. A couple other positives. Price of oil now under $60 a barrel as of today. OPEC decided to increase production. That's going to ease energy costs for consumers. That is a positive. And again, as I've mentioned before, the corporate America and the economy finished 2024 on a positive note. Being diversified has helped in this sell-off outside of small cap stocks. If you've owned international equities, which have lagged for a bit, they've certainly held up much better year to date. And as we do reviews with clients here in the first quarter, we'll point out the kind of historic gap or rebound we've seen in the international equities. The concentration in the S&P 500, which has been a risk, has flipped, and the more diversified investment vehicles have done better. And active management has added value in 2025. So lots of attention on passive investment, and that should be part of your portfolio, but we like to use both. And it's no surprise that, and it's often the case, that during volatile markets, active management can add value. And then lastly, bonds are back. They did add diversification benefits here to start 2025 and helping to buffer that equity market volatility. So what are some of the catalysts that we see going forward to potentially spark a reversal? Well, fiscal policy is probably the main one. Investors are looking to getting some relief in terms of an extension of the 2017 tax cuts. And that was largely expected, but there are several measures, including a reduction to the corporate tax rate, eliminating taxes on overtime, Social Security, and tips, all of which could be a meaningful offset to tariffs. The increase in revenue from tariffs is also going to likely pave the way for a cut in the corporate tax rate, which would also be stimulative for the economy. So some catalysts there. The question is, how long does that take? It seems at the earliest, late May or June, would be, again, the earliest that a tax bill could get put through Congress. So still some questions there and some time to wade through all that. The Federal Reserve is likely to cut rates more than anticipated. The futures market is factoring in about 3 to 4 interest rate cuts. That's up from 1 just over a month ago. So big change in rate cut expectations. Last Friday, Fed Chair Powell talked about that he needs to see more data. He was unmoved, frankly, about the reaction in the markets, that it's too early to make a policy change based on what he's seen, but the markets may force the Fed's hand. So rate cuts, if they do come to offset slower economic growth, could be a positive for the markets. And lastly, from a kind of a technical perspective, there were signs of indiscriminate selling on Friday. We saw that again yesterday, Monday, and the sort of sell what you can mentality in the markets. That's usually comes towards the end of a sell-off, or it's the first signs of the markets establishing a base. Pardon me. So that is kind of one of the signs we look for, excuse me, to determine if selling has exhausted itself. So I think we've seen the bulk of it, and you're starting to see signs of panic that would indicate we're closer to the end of the sell-off than the beginning. Again, it could be I expect a choppy market here over the near term as we sort through these uncertainties. Signs of investors buying insurance in the form of puts and a growing number of stocks falling below their 200-day moving average are other signs we're looking at to determine the extent of how that selling may have exhausted itself. Okay, so as an investor, should I change my investment strategy? We would be strong proponents here. If your financial plan has not changed, then you shouldn't change your investment strategy. Volatile markets are a feature of investing. It's the price of admission for higher returns in the longer term. And going to cash, moving in and out of the market can do a lot more long-term harm than good. So selling into cash or for cash requires you to time the market correctly twice, once on the way out and once back in. That's impossible to do. And keep in mind, some of the stock market's best days come within a few days of a big sell-off. So it's important to stay invested. Don't miss those rebounds. Stick to your plan. If you do need cash over the near term, consider a more, and I mean 3 years or so, or there might be an increased probability of that. Do consider maybe a more conservative investment strategy, one with more bonds. But again, don't abandon your long-term investment plan. We really feel that would be a mistake. And just a reminder on how volatility is normal. Obviously, we've seen sharp sell-offs with COVID. We've seen the great financial crisis. We saw the dot-com bubble. Stocks always bounce back from this. We expect that to be the case again here. This does happen periodically. And just to put it in a more year-to-year context, since 1980, the average intra-year decline, this is peak to trough on the S&P 500, is 14%. Yet 75% of those calendar years have been positive. So it is a feature of the equity markets, a good reminder for that. And now is a good time, again, to look back on your financial plan, make sure you can withstand some of that volatility and have cash needs. Things we're monitoring in the portfolios, potential rebalance. We use volatile market environments like this to rebalance from fixed income that may have held up better into stocks, and you're buying at more depressed valuations. So that's one tool that we intend to use in your portfolios. And also look at tax loss harvesting to ease potentially the burden of future crises. So or tax capital gains, pardon me, get my thoughts across there. So those are two levers. We're continuing to monitor for potential changes in the portfolio, of course, as well. But rebalancing and tax loss harvesting, two things you can do to help manage volatile periods such as the current one. So those are all the things I want to say on the markets. Again, I think this is going to be sort of a choppy session that may last with us for a while, but again, not unlike prior crises that have hit the markets. This morning, stocks opened higher on news that tariffs could potentially be negotiated. We'll likely hear news on that back and forth. Stocks have given up a lot of that gain here in afternoon trading. But again, lots of headlines to buffer the market going forward. I'll pause there. Let me see if there's any questions. And one question, will sentiment be a driver going forward, or do you feel that the drawback is truly priced in? I think the majority is priced in. Sentiment is a good contrarian indicator. As I mentioned, it's about as negative as you could get it. Some measures of sentiment could go even more negative. So in terms of the sentiment, very negative. You're seeing some very negative headlines on recession and recession calls. That type of negativity, I think, is a requirement for a bottom in the market. That's there. What I think we need to see is probably a little more in terms of the market flushing the weaker hands, so to speak. And given the lingering uncertainty on profits and economic growth, I think more is needed there. And most severe sell-offs usually require some time to heal the damage. COVID was a rare example where after a severe sell-off, the market bounced back immediately and really never looked back. Stocks resumed higher. But for most sell-offs, it does take weeks or months for some volatility, choppy trading before an ultimate low or bottom is put in place. So I think that sentiment is largely there. It's now time for kind of the volatility chopping to assess what that outlook is going to ultimately entail, and that's going to take some time. Any other questions? Question, should I put more money into the market now? And the answer is yes. Timing is a blunt, they wouldn't try to time it, but you're getting a significant uh, downturn in the market. And yes, to the extent that you could put more money to work, this would be a good time to do that. You might have a time to do that in a week or two. We don't know what the ultimate bottom is, but you are getting a significant discount for equities. Any other questions? Last call for questions. Oh, we got two more. Do you think the Fed will be behind the ball or sort of late on rate reduction? That could very well be the case. They were late on the way coming out based on Fed Chairman Powell's comments Friday. It sounds like they will be late as well. But the Fed might be forced, their hand might be forced. We'll see. As of right now, they're leaning to being late, but we don't have enough information yet on the impact. So we'll see. Futures, I believe, are about almost 50% probability of a June rate cut. We'll see if that materializes. That would be very early, but something to watch. So definitely a risk the Fed will be slow to cutting rates, but too early to assess. And can you confirm the rate drop expectations for this year again? And yeah, as of this morning, futures indicated almost 4 full rate cuts by the end of the year, putting the overnight rate around 3.25, 3.5. So that would be a pretty significant drop. I think the 2-year Treasury is signaling that already. So we'll see how the bond market may force the hand or signal even more in terms of expectations for the Fed. Last call for questions. All right, not seeing any. Thanks everybody for your time. We do have a webinar next Wednesday. I encourage you to attend. We'll do a little longer with charts and our overview of the economy and stock and bond markets, as well as any updates, of course, to recent market volatility. Thanks again. We look forward to speaking to you soon.